The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Become a Pro course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Hello and welcome to the Become a Pro course. Of course, here we have Robert Blackwell as your host, of course, as always. Welcome to Forex Academy. We are approaching lesson 7 here. We will be discussing today the components of technical trading. So quite in depth, it'll take quite a practical outlook on trading, and I do hope you enjoy it. Now, before we do continue, of course, please consult the following disclaimer. There is risk inherent when trading the financial markets. And just a few pieces of housekeeping before we begin today's lesson. Of course, feel free to ask questions throughout. It is a completely interactive webinar. So that means that you have a chat box there located on the right-hand side of your screen. You can ask questions throughout there. Even ask me to stop and go through something again if you'd like some clarification on some of the study that we'll be going through today. In terms of the recording, of course, this live webinar is recorded as always and will be placed into your members login area once we have concluded. So you will have an opportunity there roughly 1 hour after today's lesson. It will be provided to you as a recording for revision purposes in your members area. As always, again, we will be hosting an extended Q&A session at the end of the live webinar to address all of the topical issues of today's education. So where are we in terms of the Become a Pro course? We've been enjoying the first 2 weeks, of course, really getting into the nitty-gritty of technical trading now. We're going to be discussing the components of technical trading today before going on to technical analysis 1 and technical analysis 2 this week. So this week will be quite heavy, quite constructive in terms of the technical analysis we'll be delving into. Of course, if you recall, and to recap on some of the previous education in terms of last week's webinar, we discussed a lot of the fundamental cases in terms of sector analysis, supply and demand, and really get into fundamental criteria to the makeup and financial structure of many of these markets and asset classes we trade. So now that you have that fundamental background, of course, we'll look to develop on that this week with a lot of technical work. And this lesson today will give us a nice structured approach just to settling into technical analysis in understanding both really price action itself and historical context in terms of technical analysis being a study of price action data. So let us delve into today's lesson, of course. Technical analysis then, when we discuss them as components, technical analysis itself involves evaluating market securities on the basis of the statistical reference the markets generate. Okay, so for example, past prices and volumes. Now, as we go through much of the technical analysis this week, there are many different ways that you can look to statistically verify market movement, and we'll be doing that in a lot of detail. For today, though, we'll look at an overall outlook of technical analysis, both as this historical outlook on price and price action itself. Technical analysts are not interested in measuring a security's intrinsic value. So although we did a lot of fundamental analysis there over the last 2 weeks particularly, we're going to branch away to really focusing not on the intrinsic value of a certain security, but on simply looking to trade its price. Instead, we observe charts to determine the patterns that will influence future activity. Just as there are several fundamental investment styles, there are also many complex technical trading strategies traders apply to the markets. Okay, some employ technical indicators, other technical indicators and oscillators, whilst others simply rely on their assessment of the most current price action. And for most part of today's lesson, we'll be really delving into not simply looking at the structure of a Japanese candlestick, but to really delving into price action itself, because we know it's simply the relative move in price. We can actually look to forego all of this fundamental analysis in its basic assumption as a technical trader. So let's discuss these 3 main assumptions of technical analysis. Okay, number 1, history tends to repeat itself. Okay, so again, we're taking these assumptions on board if we decide to incorporate technical trading into our analysis. And of course, many traders are 100% or completely resolute to their technical trading strategies and trade quite well and quite successful as a result. So history tends to repeat itself. Number two, prices move in trends, and that is, of course, for the most part, very, very true indeed. Of course, you do often see markets push away, they'll trend, and then they'll settle and they'll consolidate or find some sort of level of congestion and consolidation. That's okay, that's the case, but then once that, I suppose, price congestion or consolidation breaks down, well, they're going to move in a certain direction over the long run again. We very rarely see a market that trades for 6 months or 1 year or 2 years in a very, very tight price range. And number three, the market discounts all relative news and data. Now, does that sound familiar? The market discounts all relevant news and data. Of course, it's one of our key assumptions of efficient market hypothesis there in webinar 4, where we believe that everything's structured if we're trading free markets, i.e. free capital markets, all relative news and information is fully available and is embodied in the price as all these market participants are trading. As soon as that news becomes available, of course, there's new price discovery and we trade upon that news. To put it into context, you often hear some securities, some traders even on the news, they are accused of securities fraud or perhaps insider trading. That would be the opposite side of that trade, where you have news about a certain stock that isn't allowed to be released to the market, or you have inside scoop and you're actually trading as a result with that inside information. Relevantly, that would actually not be condoned, of course, and is of course illegal. So that makes more sense now, the assumption that markets are efficient. All readily available news that is to the market is embodied in the price. So the market discounts all relevant news and data. So let's discuss these in some more detail, in structured detail here, okay? The repetitive nature of price movements. Again, price, let's go back, history tends to repeat itself. The repetitive nature of price movements is usually attributed to market psychology. Market players tend to offer consistent reaction to similar stock stimuli over time. Okay, so whether you're trading stock markets, whether you're trading foreign exchange, there's a similar consistent reaction to similar price movement. Okay, so that's kind of how we're how we're constructed as human beings. Of course, we have a level of repetition. Technical analysis employs chart patterns to help understand trends and analyze market movements. As humans, we share this repetition in nature, so it is entirely considerable that the markets unconsciously conform to such aspirations when markets reach all-time highs or lows or touch significant historical levels. Okay, just think about that logically. If you get oil, which is now on a bull run, I suppose, for the last year, since it was trading in and around, I believe the low was in around $26, $27, which was crazy to think now. We're now up at $70 per barrel. If we get trading up towards the 120, 130 mark, those will be all-time high levels in oil again. And that will be significant. Of course, just think how significant that would be in pricing the commodity again, and traders will look to react as such. Moving on, as far as technical analysis is concerned, price movements are believed to follow a trend. So that brings us on to our second point, of course, that markets will trend, which means that once a trend has been established, the future price movement of that stock or security is more likely to follow the same trend than to go against it. Now, isn't that totally conceivable? Of course, if you're looking to trade with the trend, and that's why, for the long term, it's advised, and there's often rhetoric there. You hear the trend is your friend. If a market is trending to the upside and you take 10 trades with the trend, looking for certain pip winners, of course, it's entirely conceivable you're going to have more success trading with that trend over the life of those 10 trades. Whereas if you're going to trade 10 trades counter trend, trying to fade the trend when the trend is moving to the upside, well, of course, it's entirely conceivable that's not wise, that you're more likely to have more losers than winners because you're trading against the trend, against the grain. Okay, so most technical trading techniques are based on this assumption. Yeah, prices, they can consolidate. Of course, they can trade horizontally for a while, but moreover, they trade and trend to the upside or downside, and a well structured. That's a simple market structure that we covered in previous lessons. And we assume that any given point in time, a securities price indicates everything that has an impact on the business, including the fundamental factors. Okay, so if it's a foreign exchange market, what business has that movement of price? There are, of course, unquantifiable amounts of things that change the price of Forex markets or Forex pairs, but everything is embodied in that price as best possible. Of course, there are times when the market, perhaps, Mario Draghi, the ECB president, says something and the market moves in one direction but misprices it. That's another thing completely. But the fact that when new information becomes available, it is somehow being priced, whether correctly or incorrectly, building in that news, embodying that news into the price. Technical stock analysts believe that technical analysis, along with market psychology and economic factors, are all factored into stocks, which removes the need to consider these factors independently. And that's the point that we make. So we don't need to consider these factors independently. Sure, everything's embodied in the price anyway. Then we can simply trade the price. Isn't that quite an assertion? It's comfortable to know that I can trade the price of wheat. You can trade the price of corn. You can trade the price of cotton. We can trade the Japanese yen against the US dollar. You could trade the Russian ruble against the US dollar simply by looking at the price action and gaining a level of assertiveness to your study, whether it's technically or just based on the price action. You are, of course, trying to develop a trading edge, of course, when it's really, to be quite honest, something I don't know too much about in terms of all the wealth that I have over these financial assets. What price is the Russian ruble? Of course, there's going to be many different factors, but we can trade these. So the point being, of course, is that this is the FTSE 100 here. The price tells us a story. That's all we're trying to do. I kind of give the example sometimes that what is this we see in front of us? Well, it's no more than perhaps a book where each candlestick is one page, and it tells us, it's trying to build out a story for us in terms of an equity market run or potential news event, economic growth story or stability story. Of course, the story will be different for every asset that you'll look to trade, but the key focus is that the price tells us a story, and you could perhaps break this book up to several different chapters. What we have here is an economic growth story in the short term. Then we know, well, we had global uncertainty. That was the story for 3 months, of course, and it brought the equities down to new lows here. If we look at the FTSE 100 in front, well, it inevitably brought the FTSE 100 equity index, the primary index in the UK, to from 7,800 to 6,830. Okay, so it's a huge move. Then we see FTSE overperformance, and again, this is in tandem with other financial equity indices that are, of course, correlated, whether are trading one way or another, but aren't necessarily telling the same story as the FTSE 100 overperformance. This is our trend to the upside. Okay, now of course we're not privy to these moves, when they present themselves, but what we can do is simply look at the price section to give us clues to see how the rest of the story is going to unfold, and then we trade as such. Very simple. That's what we try and focus in on, trading what we see. Okay, if we are able to make better assumptions on the movement of this price expression, we can forego fundamental decision making. Again, that sounds like our efficient market hypothesis for EMH. So it's certainly the case. We could have had 3 very good trades there where we don't really know the fundamental story within the equity market, so the makeup of the FTSE 100 or the equities within it. We're just simply trading a sentiment-based trade based on the story that the Japanese candlesticks are telling us here. So here we have another market where we can simply look to build out a bigger picture to trading different asset classes. And I've chosen this here because it's quite relative and because we've done a lot of study on sector analysis. We've done study last week on trade flows and capital flows, but now it's quite relative in the same sense that the price just tells us a story. And we're bringing all this knowledge back to fruition, back to the point where we're looking at technical analysis to say, well, we have this knowledge, but how can we use it? We don't need to know the makeup perhaps of the US Treasury market and what moves capital flow within, although it's going to be assertive and help us if we do. But If we know that perhaps there's going to be a story behind this move in the US 10-year Treasury bond, well, how would that let us to lead to trade other assets? So the UST bond here, the 10-year bond, is now trading at 3% yield for the first time since 2010. You can see that on the chart. Very, very significant. Again, adding some historical context to a lot of not only trading this market, but to a lot of our thoughts about pricing and risk. What story does this tell? What story does this tell, and how significant is it for financial traders? Well, we see the long-term low there around September 2010, just after. And again, there's now a total repricing of risk in markets because there's a 10-year bond. There's an attractive investment there in the United States offering 3% over the duration. We now know that other assets are going to be priced accordingly because there is going to be a shift in investment. We know that potentially as these 10-year bonds are adding more attractive value to the global markets, well, other markets will share that same context. And again, it's total historical context based on where the price is. So let's delve in deeper again, just not building too much fundamental discussion, but let's really get into the idea, the component, the grip of technical analysis in terms of understanding historical context. So here's the gold market in all its mighty, of course, trading with all its volatility. What is the significance of historical reference points in the gold market? So it's just a hypothetical question there. What is the significance of historical reference points in the gold market? And again, it was similar to looking to place, our, I suppose, discretionary levels of genuine support and resistance. But we know that there's certain areas where there's going to be historical context. Okay, so let's just have a look at some of these. Well, I'll just bring that back. What I'd like to do, guys, is to trade this market from left to right. So let's just be honest with ourselves here. At this point in time here, we are not privy to what's going to happen next. Okay, we're certainly not privy to what's going to happen in this market. But let's just follow the market up. Let's just follow it as it trades and plot our lines as the market moves up through its prices, okay? Because it'll just give us historical context, and obviously these reference points will hold weight more relative to recent price action, okay? These new highs, for example, as well. So let's just think about that and build it up as we go through the chart. So we're starting from reference point. As we move across through to new highs, we have a new all-time high there in the gold market at 1375. And the market trends to the downside, creates a bottom before bouncing. Look where it bounces again, right to our top, although it has a large spike through that. It could have been something serious there around October, November time 2016. Then we have quite a sharp move to the downside. Okay, so we have a low now, a relative low of 1127. Market trades up again, creating some little tops in here again. That touches the bottom of our previous action. Again, trades down to around 1200 level and trades up, creating all these little historical reference points for us to look to trade. As the market continues, we can see we've got quite a few of them now to gauge. So let's bring this back into practicality, guys. How would we trade this market? Well, I mean, the first thing that stands out to me like a sore thumb is this high. This high here, I'm going to be quite assertive in saying, well, given where the recent price action is, that this is very well conformative to these levels. And you can see the more relative price action. Now, we didn't get the price action up to full highs of 1375, but 1357 or 1360 in around that price for going, $15 on the gold market isn't too huge. If you're just going to be a speculator and you want to simply look at this in context, well, you can simply pick a trade to say, well, where potentially is the US dollar? Well, the US dollar is strong at the moment, but could it show some weakness? If for whatever reason you believe that the context will bring this market up to this high here again, well, you might look to say, well, look, I'm just going to make a sell trade. I'm going to short the market at this price, given the huge amount of historical context at this price here, at around these relative long-term highs in the gold market. And again, look, it's almost, it's a very well structured trade without reading too much into the fundamental analysis, because If you're looking to take a loser, I mean, if gold breaks all-time highs, you know that your signal fails. At these levels here, you know well you're wrong. You were trying to sell almost a high of gold. If you're not taking too much risk on the trade, with trade size perhaps, well, you shouldn't be under too much pressure. But with that historical context, you know that there's a good chance, given other markets and how they're trading now, and there's not too much market uncertainty at the moment. The equities are still at relative highs, long-term highs. Well, this might be a good sell trade, just given the historical context of this high. And again, you have plenty of other trading opportunities. Again, this is just an exercise of repetition. Again, albeit they're not perfect at times, we do understand that, of course, but look how well conformed some of these trades are in terms of following the price movement. And again, we can structure this more into our floors and ceiling if we want to become support and resistance traders or use other technical analysis. But can you see the surpassable content of this technical analysis, or this historical content that it provides us? I mean, does the market correspond to historical reference? Put quite frankly, does the market correspond to historical reference? I would argue it absolutely does. So let's move on to another market. We have the Chinese equity market again. This is fairly recent, guys. So we had a very, very strong bull run there in and around 2015 summertime. We know that the Chinese market was just rolling up. It was, in terms of GDP and economic growth, it was at 6-7% per annum. Fantastic growth. But we got a lot of uncertainty. I believe this was a Black Monday here. We have these relative highs around summer 2015. And then we set a precursor, guys. That is simply what it is. We're not privy to any price action that is going to outlay, albeit after a lot of volatility, we see a reoccurrence or a reformation of an equity bull run. Now, when is this equity bull run likely, from historical context, likely to stop? Okay, I mean, totally hypothetical. Is it totally coincidental that the market touches its new equity high before it reverses? Put in another context, I suppose, to be a bit more fair to you, if a current news event sparks some bearish activity in the markets at this exact point in time, when the markets are at all-time highs, well, how likely is it that market participants are to succumb to repetition? So I know I have phrased that, it's a leading question, of course, but I have phrased it in a way that makes sense, of course, to me, observing this historical context. If I know that the all-time highs are at this point in reference with the Chinese equity market, and I see the news flow, the S&P selling off, and some of the news flow is very, very bearish in terms of a correction, is it of any coincidence that the market corrects off its historical context point? So just to bear that in mind, and again, we'll look across different markets to really add value to assessing historical context, because of course there are many times that you can make poor trading decisions as a result, but there are many times evidently you get the best trading decisions from simple historical context. So there's a lot of technical analysis that we can observe as technical traders. Look, we want to learn a lot about technical analysis. However, some trades you can make are quite I suppose quite, what is the word I'm looking for? Quite basic, I suppose, in terms of our understanding to actually apply historical context. Again, let's just delete this analysis. We'll look at another market here. We have some significance in here with cable market. Okay, cable, every Forex trader, of course, is familiar with how cable trades. It's one of the largest volume, it and the euro dollar volume dollars markets in the world, of course. A very significant, more recent times, our 143 level is significant for pound dollar for traders, as it is the price sterling was trading against the dollar pre-Brexit. Okay, the pre-Brexit sterling market price before the evidential flash sell-off of sterling as a real shock sentiment to the Brexit leave decision. Okay, so that's effectively where we are now. What we've seen is a very strong sell-off right from that point in time, and again, we had a clue because we had a relative touch to our level. Okay, so without going into too much fundamental context as traders, what we might look to do is say, well, for whatever reason, this traded up and just rebounded off this level right here. For whatever reason, we've seen some more strength to the upside, and it continued on its over an encroaching trend to the upside with some strength here. And again, for whatever reason, without applying too much technical analysis, our decision, if this market comes up to this level, is to sell at this price. And again, we can choose our stop loss above the price because the signal would be invalid. I suppose the signal is the wrong word to use, but the historical context would be invalid or broken if we prove to be wrong in this trade. So we choose to sell at that price. And again, in and around here, the candlestick actually agrees with the historical context. It gives us the perfect signal, and then we make the trade. That's all we do. We make the trade based off the context price. Now, evidently, now we're not privy to this, but right now we get a very strong sell-off. It is our high of the market. We've seen sterling weakness, of course, as a result. We've seen dollar strength as a result, and it was, ironically, the time that the fundamentals backed up the historical context. But all in all, it is there in the trade. If weakness, again, totally hypothetically speaking, if weakness enters the market at these levels, does it exert more natural downward pressure? So forget about the fundamentals, but if we see some weakness come in to the markets with the candlesticks moving down, given that it's at this price, is it going to be exacerbated? Is it going to be a stronger move to the downside? And I would argue yes, because it's a historical context point. Guys, traders are all over the world are looking at these levels. You know, you hear analysts discussing these levels on Bloomberg. You hear traders making their analyst predictions off these levels. Technically significant would it be if sterling trades up and closes in around the 144 mark, because it has broken the levels, and you could say, well, it's going to 150 now, it's going to 160. So very, very significant historical context points, and these are appreciative across a wide range of markets and asset classes that are fully visible on your trading platform. You just need to have a look for them. Again, if you're choosing to make the trades, you know, patience is the game, but you can see I've given you 3 examples there that these markets have been at historical context points very recently. So there are the trades for you. So let us just take a seat back from our historical context point. And again, I want to build this into some skills in terms of technical analysis. And it's going to be a good lesson for us today. It'll be enjoyable because this will be nice and light in terms of just enjoying some technical skills before delving into the heavy technical analysis structures of different indicators, what they mean and how to properly use them and disseminate the signals that they provide to us. Okay, so we're going to discuss trading price action. Deciphering how the market is reacting in real time by assessing the structure and movement of the Japanese candlesticks is said to be one of the purest forms of technical analysis, as its objective is simple and conforming to efficient market hypothesis. And we all know what that means, of course, now. We call these traders price action specialists, and that might be something you'd like to take on board for your future career trading. The number 1 rule is, of course, trade what you see, not what you think. And that is the number 1 rule for technical trading. Trade what you see, not what you think. And of course, if you're a hybrid trader and you use fundamentals to back up what you see, well, that's fine, of course, as well. And that's the point of that, is very much recommended, I should say. But just in terms of trading price action, let's delve into price action speciality. Trade what you see and not what you think. Okay, so we're going to walk through quite a few trades here just off the charts. Okay, here we have again the market trading up at our 143 level. This is the first time it traded just up there recently. Again, we've seen 2 reference points there. So our cable market, we're looking at daily price action. How would we look to trade this? What do we see in front of us, guys? Is there something sticking out like a sore thumb? Oh, I should have sold the market there at that price, or I should have bought the market at that price, or how is this? Are there structures available? What do I do in the purest form of technical analysis? So let's just walk through a trade from start to finish here. Well, we see bullish trend to the upside, okay, and that is climaxed, of course, that we're not privy to at this time, but what we see is an engulfing bullish candle. So this would actually suggest to us, well, price is going to continue to move to the upside. But again, let's just try and read the story here, okay? Now, it's fine, you could have bought the market at this price, you could have made short-term profit, you could have, of course, done very different things. But let's try and read through a total trade here in terms of defining the market structure and trading price action. So we see a bullish trend, we see the engulfing bull candle, inevitably, or not inevitably, sorry, but considerably significant at this time, the rejection to the upside and the structural high is created. Now, how is that created? How is that created? Well, this candle is very significant here. This rejection candle for us is very significant because it trades up, does not close anywhere near our level, of course, or the previous high here, and it trades down and closes below halfway, and also has some quite a trading range, but we can negate that. Closes just in the middle of this candlestick here, so that's significant, okay? Right there. So let's just walk through the trade then. Then we get a structure low traded. So I'll just remove some of this analysis again. And what I'll do is just zoom in on some of this. We get our first rejection to the upside, okay? Number one. Number two with candlestick 2. Then that's the perfect indecision. Again, the hanging man bearish candle. Then we get some trading, intermittent trading. But again, we get this new structural low created because we see the market trying to trade to the downside here, although it's rejected, so we take that as is. And then we see the bullish rejection from the low. So again, we're really not sure what this market is doing now, and that's absolutely fine. It's going up. This will often happen after a period of strength or a bullish trend to the upside. We need confirmation, guys. But what is significant is this low. Again, it just touches the low, and again, that's right at our new structure creation here from our engulfing bull candle. Then the market trades up, and again, just look at the high of this candle. Look where that high of the candle is. And again, the market trades up. Even though it's a bullish candlestick, it cannot trade and close above our structure. The next candle is very significant because that is a dead cert. That is a rejection candlestick. So we'll call that rejection candlestick 3. And again, it trades quite strongly to the downside again before our real confirmation here is 4 when we get the close below the level, right of our closing below the structural low here. So that is very technically significant, reading into these footsteps of what is happening at the market during this price action trading. And again, you could suggest that, well, everything is committed to a downturn here. Again, what we'll look at just defining, I'll use a different color pen for this, because you could read into it. It depends where you take the trade, of course. That could be your entry. But again, we have a signal here where there's a level of indifference. The market doesn't know where it wants to do, but it trades up at the level again and closes below. So that's significant again. Then we get another rejection candle again. Then we get a real fierce attempt for the bulls to come back into the market. However, that is all the evidence we need, because that is the absolute rejection of bullish strength. And then we get a continuation here to the downside. So that is significant in terms of this overall story here. And again, what I'll actually do is just walk through this and try and develop this in your own mind here as we go through the structure of this trade. We retrace the range from early engulfing candle, closed below level of confirmation, and the time to sell is obviously the trade there. Okay, now that's a very sort of simplified example of how you can look at a technical structure. This market structure has certainly failed to the downside. So sometimes I like to think of it, if I was actually taking the other side of this trade, if I was a buyer to this market and I see this unfolding before me, I would not want to be long this market. So that would tell me that this is, of course, the signal, all I need to sell this market. But this is, of course, a very good example to look to trade a market structure. And again, we're really delving into how to trade price action here, okay?